Here we go.
Good morning, all. My name is Pietri Pereira, and I'm an assistant professor at Rice University. It's my pleasure to introduce Po for today's session. He's from the National Tsinghua University. We're looking at a paper, and it looks at confidential advertising expenditures and there's the motivation behind it and the consequences thereof. Just a couple of housekeeping matters before we start. First, please make sure that you are muted. Second, if possible, please share your video. Third, if you have any questions, please use the raise hand function and Po will address it, or you can use the chat box and I'll actively monitor the chat box as well. Let's give Po the first 5 minutes uninterrupted for him to give his speech. And after that, feel free to either raise your hand or jump in the chat box and I'll monitor the chat box. So Po, thank you very much. The floor is yours.
Okay. Thank you very much, Petrus, for your kind introduction. And I would like to thank everyone. Oh, by the way, can you all see my slides?
Yes.
Okay, great. I would like to thank Ayong and Professor Payman for kindly constructing this platform and allowing me to present here today. And the paper I'm going to present today, I hope is to be entertaining. Is a title Strategic Opacity or Managerial Shielding, examining the motives behind unspecified advertising expenditures. And I'm Paul. I'm from National Tsinghua University. In case you don't know, there's a Tsinghua in Taiwan and National Tsinghua, and in contrast to the Beijing Tsinghua. And this paper with Ophir and David from National University of Singapore and Xiaohui Li from National Chengchi University and Honghua Pan from National Tsinghua University. Okay, and maybe most of you know that IASB and the FAST, but they cooperate from time to time to initiate some project together. And this is a project they are working on. In 2009, it's called Financial Statement Presentation. And what they are trying to do is to collect information from analysts to see what those analysts think most useful in financial statement, or what's the best way to present financial numbers. And as you can see from this figure on the right-hand side, you see many bars of different colors, right? And it's confusing, so let me bring your attention to only two colors. One is called the dark blue bar or the purple bar. The dark blue bar denotes very useful vote, and the purple bar denotes useful votes. As you can see, across all these items, right, separation of business financing activity, this and that, and the management approach to classification, among all 6 categories, apparently the highest bar appear in the increased disaggregation. And in fact, 82% of analysts being surveyed voted favorably to disaggregation, right? Because they think this information most useful to them. And in fact, in the conclusion report of this project, the two institutes came out with a kind of example income statements, which are exactly on disaggregation. That is, they recommend, okay, this is just a recommendation. They recommend firms to specify not only their sales from wholesale sales or retail sales, but also for cost of goods sold. They recommend firms to break down material cost, compensation expenses. For selling expenses, they recommend firms to break down advertising, compensation, this and that. And under general administrative expenses, they recommend firms to break down compensation, pension, and many others. And among all these recommendations, today we're going to focus on advertising, which we consider very important because nowadays, right, a lot of firms, no matter you're high tech or not, marketing is certainly the most important intellectual activities or intangible assets a firm can have. Okay, however, not all firms. In fact, the bigger firms, they are less likely to report advertising nowadays. If you look at Apple's income statements or financial statements, you see the cost of sales, they only break down to product and services, that's it. And the operating expenses, they only break down to research and development, selling, and SG&A, that's it. They don't really tell you how much advertising they spend, how much compensation they spend, this or that. And so despite the fact that we saw Apple's commercials, every day, right? But we just don't know how much Apple really spent on advertising. Okay, well, then the issue is that, is it big deal? Right? If it is not a big deal, then maybe that's totally fine. But in fact, analysts complain and the media cover this. In this example report, the title is Apple mysteriously stopped disclosing how much it spends on advertising. And the issue was raised and shared by a Wells Fargo analyst. He or she says that it's such a shame that now it's no longer possible to track Apple's advertising expenses. Okay, and this is a complaint from the analyst side, but we can look at the fact side, right? Like how much advertising cost we are talking about and if you look at this yellow bar, and you can see that Apple stopped disclosing advertising in fiscal year 2016. But before that, you see actually escalating, right, advertising expenses on Apple side in advertising. On the yellow bar, we are looking at a number close to 2 billion in 2015. But if you look at the blue line, right? Blue line denotes the ratio of advertising expenses to total revenue. As you can see, we are looking at consistent like a 0.8, close to 1% of revenue high advertising. So if you look at this trend, we expect this amount to get higher and higher, but suddenly Apple, boom, stop reporting that. Okay, so certainly based on analyst complaint and the real number, we consider this is a major issue. Especially nowadays, I started my career doing like a R&D and a patent, but nowadays I'm switching to more intellectual, intangible assets such as trademark, brand name. So that's why advertising now become a part of my, an important part of my pipeline. So that's why I was intrigued by this research question. Yeah. Okay. And yeah, we are looking at, very high, but then Apple started disclose. Okay. So then the issue is that if Apple doesn't report its advertising, then how do we know? Oh, okay. Yeah, Professor Payman.
Yeah, I just want to a perspective here. Most companies, they do report advertising in the first footnote, the accounting footnote. So
Yeah.
advertising and promotion. I'm surprised by Apple. I didn't know this. That seems to be an exception. So exceptions are good to note, but the general principle is you do get advertising and promotion in the footnote, in the first footnote.
Yeah. Okay. A quick answer is that CompuStat item XAD sometimes include those footnote, but we also manually check. Later, we also in the later part. In fact, thanks to our discussion, Dr. Skinner, he discussed our paper at the ABFER conference, and he recommended us to go to this old footnote and collect all marketing related expenses. So we have done that, and we are going to talk about it at the very end. But unfortunately, most of our researchers, we rely on CompuStat data set. So we collect their advertising based on CompuStat item XAD. So we call this CompuStat reported item as reported advertising expenditures. On the other hand, there's a famous marketing consulting firm which is called Kantar Group. And Kantar Group started to collect and calculate how much a firm spent on every brand every year since 1991. So we also get the data from Kantar Group, and we call that. Oh, by the way, Kantar Group is very detailed, but we aggregate all expenses at the firm level, and we call this estimate as observed advertising expenditures. So to be compared to reported from CompuStat. Yeah. Yes, Patrice.
Just want to, how often do firms switch between disclosing and non-disclosing? Is this a sticky measure, the choice to disclose or not disclose?
Yeah, I think it's quite sticky. Yeah, it's quite sticky. Usually firms, when they start, they will start for like 5 years or longer. So they wouldn't be on and off. They wouldn't be on and off. Usually it's like maybe even through one CEO's term. Yeah. And actually, what surprised me when I figure out this truth is that how come those auditors, those auditing firms allow this to happen? Right? Yeah, but I'm a finance guy. I shouldn't talk too much, but yeah. Dominica? Yeah.
Yeah. I was wondering, does the market penalize these firms for not disclosing when they don't?
Yeah, exactly. That's what we are heading. You are going to see our summary of result very soon. Yeah, that's what we are going to show you. Yeah.
Because if there is no penalty, then why would they provide it? Right?
Oh, okay. There is penalty. There is penalty, and we are going to explain what's the rationale behind such a managerial choice.
Thank you.
Yeah. Okay. So yes, we have CompuStat reported number, and we have Kantar observed number, and so we are going to before we talk about hypothesis, that's important for us to tell you that we group firms into three groups. The first group, we call it unspecified advertising firms. That's how our title came out, with unspecified. That is, we couldn't find their advertising from CompuStat. But according to Kantar group estimate, their expenses are larger than or equal to 5% of pre-tax income. And of course, you may wonder, so Paul, why do you use this threshold? We follow Chowdhury, I forgot which, Chowdhury jar paper. Yes, and then this is the first group, unspecified advertising. They indeed incur substantial advertising costs, but they just don't report it. On the other hand, we have immaterial advertising firms. That is, you couldn't find the advertising in CompuStat. And also, indeed, their Kantar reported costs are smaller than 5% pre-tax income. So their advertising is really immaterial. So that's why we call it immaterial. And then the last one is called reporting expenditure firm. That is, the CompuStat X80 is non-missing, and the Kantar is also non-missing. And we call the group 2 and group 3 as we call it disclosed advertising, because they indeed disclose appropriately their advertising. But the first group is our 3D group. Our focus group is unspecified advertising firms. And now, what's the rationale behind, right? Like why some firms choose to, like Apple, choose to not specify its advertising, and other firms choose to disclose their advertising? Well, one argument is called proprietary cost argument, and these scholars suggest that firms shouldn't specify their advertising expenses because they want to keep their competitive advantage. They don't want to be imitated by their competitors. Okay, they have a good reason not to let people follow their suits. But on the other hand, there's another camp. We call it agency cost argument, saying that, well, indeed, if you allow firms to hide the information, actually they will increase information asymmetry. That will exacerbate the information environment for investors, right? So we actually have a two contrast argument. One is proprietary cost, which is support unspecified advertising, but we have a agency cost which goes against unspecified advertising. Yes, Ayo?
That whether proprietary cost argument really applies here, because the fact that you as an external researcher able to buy the advertising data that has been public, because those advertising eventually are disclosed to a broader public to sell those products. If we can observe them,
correct.
have bigger budget to purchase it, and that's kind of like is already. What's missing is this is the aggregate amount, but like whatever you are able to aggregate through those different data vendors, I'm sure competitors can also do the same. It's not like R&D is kind of in-house. Competitors cannot really figure out how much investments. I think for advertising, there are some other alternative sources other than accounting reports that is available to competitors.
Yeah. I totally agree with you. So I'm glad that you also find that this as evidence against the proprietary cost argument, right? And so hopefully our reviewers will agree with you. Yeah, will agree with us. But anyway, that's so okay. In the next slide, I'm going to talk about how we our hypothesis. Yeah, that is what I'm trying to do in this paper. we look at consequences, right? If there's any consequences on analyst assessment or like a firm valuation, then we can say, oh, this is some phenomenon worth analyzing. Because if there's no, substantial consequences, then maybe that's not something with. Oh, I see something in the chat box. Okay. Actually, up to firm level as noise. Okay, thank you, Professor Libnet. Yeah. So our first hypothesis is that. Oops. Why this doesn't? Oh yeah. We first hypothesis that if firms don't disclose their advertising, that analysts will show greater forecast dispersion because they are subject to higher information gap, right? So they will have have higher disagreement with each other. And our second hypothesis is that when analysts don't have sufficient information, then they may become more pessimistic about unspecified advertising firms because they may see, if you don't disclose what you are doing, why you are spending, then it's analysts have reason to doubt what's going on, right? So this is our second hypothesis. And if analysts' assessment is biased or influenced by such hiding, then actually firm valuation will be affected too. So our firm valuation would follow our first two hypotheses. Okay, if there's a real impact as stated in our H1 and H2, then we look at the driving factors, right? In the previous slide, I have mentioned proprietary cost is an argument mentioned by Liang in her JAE paper. But in this paper, we try to propose another reason, that's agency costs. And we formulate as our third hypothesis, that is new CEOs are more likely to keep advertising expenditures unspecified. Why? Because new CEOs, they are less experienced and they are more vulnerable to the outside criticism, right? And so if they can choose, then they have incentive not to disclose too many expenditures or too detailed, because otherwise they'll be asked, okay, why are you spending so much on this? Why are you spending so much on that? Or on the other hand, maybe they also need to have more flexibility. When you start a project, you don't want to disclose too much, especially to your competitors. But then there will be to proprietary cost argument. So, but anyway, we focus on agency cost side, and more importantly, we another contribution of this paper, we reconcile those two arguments by showing that under what scenarios one factor is dominating the other. Okay, and I guess our conclusion is that both costs exist. It's just like one is bigger than the other in different scenarios. And we highlight the scenarios. That is basically industry competition and also CEO's job risk. Okay, the turnover risk. Yeah. Okay, let me quickly summarize our result. So just in case I couldn't finish the paper, that is regarding to our first question, do unspecified advertising expenses influence analysts and investor? Our answer is yes. We first found that if a firm chooses not to specify its advertising, actually this firm's analyst forecast will have higher dispersion and lower forecasts or downward forecast errors, because analysts are more pessimistic. So they made a lower EPS forecast on average, supporting our H1 and H2. And now, of course, common questions from the audience would be, well, then analysts, they are professional, they can buy Kantar data or they can other information sources, right? And yes, that may be true, but we also look at, in order to pin down the real information source, so we look at transcript in the earnings call. And that is, we collect the question raised, marketing-related question raised by analysts during earnings call, and also the answers provided by executives during earnings call. And we found that indeed analysts ask more advertising-related questions for these firms, because they show their effort to mitigate information gap. But guess what? Executives of these firms actually choose not to share additional soft information. Okay, so what he suggests is this is a kind of managerial choice somehow for some reason the manager they choose not to share too much information to mitigate information gap, to deliver soft information to analysts to mitigate the information gap. So the result is analysts were kind of dissatisfied. So indeed, so firm's valuation is also lower. So firm's valuation is discounted. Yes, Professor Payman?
May I suggest you look at sales forecasts? I mean, advertising begets sales, right? We know, as I understand the literature, I'm not that close to it. Analysts are much better at forecasting sales than EPS. EPS has a lot of those other items down the income statement you'd have to control for in terms of forecasting, whereas sales is very much connected to advertising, and they seem to be relatively very good at that. They're not that good on EPS forecasts for a number of reasons, which advertising disclosures would only be one.
Yeah, that's a great idea. Thank you very much, Professor Payman. Thank you. I think Brett. Hey.
We started talking about the three groups at the beginning of your talk. You have those that disclose, the unspecified, and those that do not have any material.
Correct.
Advertising. When you summarizing your results here and comparing the unspecified groups have higher uncertainty or dispersion and lower valuations, compared to which of those other two groups, or those other two groups are combined?
We call it disclosed group. So that's why we combine the second and third group. We call it disclosed.
Yes.
Right. So they either they disclose, even they not disclose anything, which means
disclose zero, right? They don't have
any. They disclose zero.
So I understand that, but have you considered splitting out those two as two different benchmarks? Because I think in my mind it's a little bit different comparison. If you were comparing the unspecified with those that disclose and actually have them, then that might be one interpretation versus the interpretation of really the value of your paper, I think, is that you can, using this unique data, get in to distinguish those that do not have any material versus those that do not disclose. I think that might be an interesting comparison as well.
I think, we will certainly, we thought about that.
I guess part of my reason too is if I'm an investor and I'm looking at SG&A and I'm saying some firms have some advertising there, I don't know, or a large portion, and some firms might have the exact amount of SG&A, but just be very inefficient with their other expenses. Do you know what I'm saying? How I interpret that? Because I don't know how much is advertising. I'm trying to hold two firms constant. One has advertising, it's not disclosed. The other doesn't have any, right? But they have the same amount of SG&A, and how that gets interpreted as far as uncertainty and valuation. Just a thought of thinking about the benchmarks, the comparison.
Maybe when I talk about summary statistics, maybe we can get some sense about the relative. Okay. And
Joshua just spoke. Joshua has a question. Are the unspecified group abstain from disclosure of other items?
Abstain from other disclosure of other items. I think if Professor Livnan's question is about whether they disclose other marketing related, if they disclose R&D or not, we don't know, or we could know that. But if they disclose other marketing, we include those other marketing or promotion related expenses in our robustness checks, and by manually collecting those footnote numbers.
But I also have a question on the objective function of the manager. So if the manager knows that the firm valuation will be lower and the manager's compensation is based on firm valuation, how do you reconcile these two ideas? Or do you have in mind that a manager doesn't know that it will result in firm valuation?
Of course, I guess your question may be like, managers, if they care about firm valuation, if such a non-disclosure will hurt their firm valuation, right? Why should they choose so? Yes, but if you see our test, you will see when CEO face their job risk, right? Then the job risk should be top priority over the market valuation. So I guess that's why I can answer you now. Of course, there are many other reasons behind, I will assume, And For our third hypothesis, are new CEO more likely to choose not to specify advertising? Yes, we find indeed that that's the case. Why this doesn't jump? Okay, yeah, indeed, we find CEOs with a shorter tenure to their current position, they are more likely to choose not to disclose advertising in their financial statements, and more likely to switch. If they can switch from disclosure to non-disclosure. Yeah. Okay, let's take a look at our sample, then we'll talk about some statistics related to Brett's comment. We focus on intersection of US firms in the CompuStat dataset Kantar. So a firm in our sample will need to be both in CompuStat, regardless they report advertising or not, but they need to be CompuStat. And they also need to be covered by Kantar, so we can really observe how much they spend on advertising for their brands. Yeah, Ayong?
No, I just want to kind of repeat that Joshua Lignett in the chat box. I think his question is about whether new CEO just want to not report any disaggregated line items. It's not specific to advertising. They just don't want the detail, because your earlier answer is that they don't want to provide any detailed cost items. So that would, have you checked any other line items that should apply to?
Yeah, I think that's a very good comment. We thought about that, but we don't have a good idea how to. Basically, it's almost like how disaggregated, right, or how aggregated the firm's overall statement is. We don't have a. Oh, maybe one thing we can do is we can calculate. We can say we can list 10 items, right, and we look at how many items are missing, and so we come up with a measure. So yeah, indeed, total. Disclosed item.
There's a few papers about that. Just they use XBRL tags and then just count how many items are disclosed.
Oh, I see. Okay, yeah, we will look into that. I will ask you for further details. Yeah. Walker?
Hi, Paulson. I just wanted to suggest maybe have a determinants model first to see what is correlated with the non-disclosure of advertising, because you really want to collapse all those determinants to hone in on the advertising dummy, right? And then project all your outcomes solely on that. Without that, it's all endogenous, and reviews will always say this is capturing something more intrinsic, which is endogenous, correlated, more of a sticky nature of these firms that don't disclose. Maybe they're the bad types. So I think collapsing those determinants would then allow you to focus on just the non-advertising disclosure decision. Without that, I think it will be difficult to achieve all.
Yeah, I know that's about a advertising issue. Yeah, we at the end of our talk we use a DID. We use FRR 44, which is if you allow me, anyway, we are going to do DID. We are going to regulatory shock, which allows some firms to choose to switch and some firms choose to stay. And we find consistent result using that DID. Yeah, Petrus?
I just want to add on to what Ayung said, and not me, Sudipta Basu. He also mentioned that you could look at missing R&D, the fact that firms do not disclose R&D separately or disaggregate. And he refers to a specific paper, Dura and Reap 2016.
I see. Okay, yeah, we can certainly using missing R&D as a kind of another indicator, yeah, for this total disclosure, total disaggregation level. Okay, so with Dominique.
Yeah, I was just wondering, like, what are they talking about in the earnings call? Like, are they diverging the investor attention away to other items within, let's say, the R&D or some other items? Or how are they able to take the question and respond? So it's
in fact, we look at those financial statements. If you look at Apple's financial statement, you will be amazed. I don't know about you, but when I look at Apple's financial statement, I was like, boy, such a big company reports so few items. It actually so amazing to know that. So I guess at least my impression is that if a firm okay, and I guess your question, how do manager avoid or
yes, exactly.
or digress the investor attention. If you ask me, I feel that those big companies, they don't even care. They don't, as long as the auditors allow them to present a report like that, I guess no one stopped them from hiding more. Yeah, I don't know. That's my interpretation. Yeah. As long as any auditor allows you to do so, then nothing can stop you. I don't know if that's my answer. Yeah. Christina? Yeah.
Yeah, hi. I mean, I was looking at the Apple data, just right now, and I noticed this is a recent phenomenon, and I was wondering whether this lack of advertising, not just in Apple but overall, if it is a recent phenomenon, then it has to do with the way the channels that companies use to advertise the products, because nowadays it's not just the usual television or radio, but it could be also other channels that are could be private, internally, generate, let's put it like that. I mean, Apple has a lot of digital, ability in any way. So
but those are still advertising, right? So I don't know. Yeah, I guess you are saying that they can say that this is alternate channel, new channel, so they don't need to classify as advertising, or
yeah. So what is remaining is a very small amount, so they don't really need to classify. I mean, it's a small amount. So I don't know. I mean, it is just the thought that it's a change of the channels of advertising that really brings about this ability that I don't know.
Okay. In fact, okay. In fact, let me show you. When we aggregate, yeah, I know there may be some issue on the chat box, but then we come back to it later. Look at the aggregate. If we aggregate all kind of unreported advertising by Kantar, actually you will see we are talking about billions of dollars every year. So we aggregate all public firms, we are looking at $1 billion, like 7 to 8 billion. Oh, but some of you may say, oh, okay, this number may not be big. Okay, let me tell you why. Because Kantar estimate is a conservative estimation already. So if you look at 8 billion here, maybe it's like a 10 billion, 20 billion, or even 30 billion unreported advertising. Yeah, I guess that's the key message of this chart. And more importantly, that's related to Christina and many of yours earlier question. When we group those Kantar reported advertising into 20 groups from high to low. Okay, from low, you can see from a red line, from low to high. And then we look at the ratio of unspecified firms in each bucket. Guess what? You see, those firms, they actually spend more in advertising, actually report less. In the toughest bucket here, you actually have what? Have 20, have 15% of firms don't report advertising. So the more you spend, the less likely you report. This is an overall phenomenon, which is amazing. Yeah. Okay. So now let me talk about summary statistics. That is, if you look at overall firms that appear in both Compustat and Kantar, reported observed, you see the average Compustat firms report like 120 million advertising, and the Kantar capture like 1/3 of it, 42%. Of course, you may say, Paul, then this just 1/3. Yes, but this correlation of 75%, and also because Kantar's only capture those they can track, right? But Compustat, the advertising is the overall thing. But anyway, Kantar is already the best sources you can imagine from experts. But on the other hand, if you look at those unspecified advertising firms, they are looking at the 15 million. So this is, in fact, this number is even higher than this. So we are looking at substantial firms don't reporting their advertising. But if we look at immaterial firms, actually we are looking at 3 million only. So they should just ignore this item. So that's the summary. Oh, but in terms of firms, immaterial firm would be like half of sample. And in our sample, like 60% of firm year, or we construct a firm year panel, like 60% of firm years are unspecified advertising. So this ratio, well, I wouldn't say super high, but it's also not negligible. Yeah. Okay, so this is a test for our first hypothesis, whether analysis focus are more dispersed. And indeed, yes, when we regress analytic focus dispersion on a dummy for whether a firm is unspecified, controlling for year fixed effect, firm fixed effect, and all bunch of control variables, which of course we haven't exhausted all possibility, which we will take into account in the next version. We see significant like 5% higher increase in dispersion. Yeah, which is reflect a higher uncertainty for analysts in assessing unspecified firms. But if we look at their focus area, we define focus area, analytic focus minus actual EPS. Then we see the unspecified are associated with a 0.4% lower EPS forecast, which suggests they are indeed more pessimistic about those unspecified firms, which suggests that indeed lacking of information is a big concern even for analysts. Okay, so now to confirm this is what to say, analyst efforts that we collect the Capital IQ transcript data, and we collect all advertising related words, including marketing, brand, advertising, branding, promotion. And then we compare the frequency of these words appear for reported firm, unspecified firm, or immaterial firm. Perhaps not surprising for immaterial firms, this is not important, so the frequency is really low, like 70%. But for reported firm, I'm talking about analysts raise questions. Analysts raise questions with these keywords. And for reported firm, the frequency is like 45%. But for unspecified firms, the ratio is 50%, suggesting that indeed the analysts ask more questions to unspecified firms to show their effort, or not show their effort, to exercise their effort to mitigate information gap. And the difference is significant. However, if we look at executives' responses, guess what? We find that the reported firm and unspecified, they are not statistically different. One is 67% for reported firm and 70% for unspecified firm, such as that analysts ask more questions, but executives don't answer more, at least statistically. But of course, you can say that we are still looking at like, say, 3% of difference. Yeah. But overall, this kind of information gap and pessimism in analysts actually result in valuation discount. As you can see, no matter from the stock price to book price, or like Topix Q, which is based on equity and also debt together, we see unspecified advertising firm have a discount of like say 7 to 10%, 7% discount in terms of firm valuation, which suggests that indeed the analyst difficulty in accessing advertising related cost information indeed deliver to investor assess valuation concern. Patrice?
So you mentioned earlier that this choice is quite sticky to disclose or not disclose. And it sometimes the change happens when a new CEO comes in. And thinking about what Walker mentioned earlier about all these other unobservables that might be happening at the same time, is it possible that what's going on here is that it's a new CEO coming in? With the new CEO comes certain changes, but there's also higher uncertainty surrounding this firm and a lower valuation for this firm, especially considering that this is significant. A 10% lower Tobin's price to book ratio is quite significant. And I just wonder if a manager, any manager, knows that disclosing something will cause a 10% increase or 7% increase in Tobin's Q. It seems strange not to disclose that number.
Yeah, I agree. So that's why so I wouldn't overinterpret this result, because for various reasons. One is like when new CEO come in, right? Then the market see more uncertainty, so may suggest some drawback in this. But I think what we can do, we can see if there's a test we can further channel, right, the analyst forecast errors to the firm valuation. Yeah, we can think of whether we have some test to connect the two pieces together.
So if I may add, a simple suggestion would be a 2x2 matrix where you just look at, do firms stop disclosing, yes, no? Is there a new CEO, yes, no? And just a percentage, how often does this happen? Just to get a feel for whether this is the main driver. Just a 2x2 matrix, nothing fancy, no fixed effects, just to get an idea of what's going on.
Okay, stop reporting and the new CEO. Yeah, correct. Sorry. Ayong?
Paul, I think that so far you presented your results, and then most of your analysis is a dummy variable, like comparing across firms, and then your hypothesis is also at a firm level, whether that firm has a new CEO. And then you face a lot of question about all those firm level hypotheses and the measurements may apply to many other line items in the financial statement, right? And then related to what Steve Pemman earlier talked about is that I wonder, you can test the correlation or just efficiency or return to advertising. So you spend advertising today supposed to generate future sales growth. And you showed us a graph and also that anecdotal case from Apple that once they spend more money, they don't want to report. Is that some notion of the diminishing return? That's once you spend more, you just don't generate proportionate sales growth. And that somehow is known among those advertising spending firms, and they just don't want people to see they spend a lot of money, but there's no sales growth outcome in the future period. And then you have the continuous variable, right, at a firm level, and then you definitely can run a regression with advertising this period and the sales growth next period, and then somehow there potentially some like non-monotonic relationship across different amounts of advertising expense.
Yeah, we can estimate the sensitivity, right, or the efficiency, as you say.
So similar to the R&D, kind of like productivity sensitivity to patent output, here you will be advertising spending and sales growth output, and whether that potentially is declining over time. And then that's why people, and that is more tied with advertising and not related to other line items.
Yes, certainly. I will think I think that's a good idea, and I would need to think how to weave that into our current framework, or how to use that to sharpen our mechanism, or to help us to provide more direct evidence. Yeah, that's certainly a good idea. Yeah. Oh, I have 17 minutes left, but still plenty of time. I'm almost done with my major results. Okay, so this is for the agency cost argument. That is, we focus on new CEOs in their first 3 years or in their first 4 years. As you can see, for these new CEOs, actually, they are more likely to hide or non-disclosing their advertising when the dependent variable is non-disclosing or closing. Yeah, and we find it's fairly significant. Okay, which is support our hypothesis. Now here comes the interesting part. So how can we reconcile two arguments, right? One is proprietary cost, one is agency cost. And here let me introduce the first level. The first splitting. That is, we split firms based on their CEO job risk. We focus on we split all industry into two groups. One is a high CEO turnover industry, it's like column 1 and column 3, and then a low CEO turnover industry, right, 2 and 4. And what we try to say is that if these two groups have the same effects, then maybe it's not driven by agency issues or CEO consideration. But what we find is indeed for industry with high job risk for CEOs, actually they are more likely to hide their advertising, but not for industry with lower job security. With higher job security. So it's midnight on my side. So, but I guess you see my point. So which actually further support agency consideration or agency cost channel here. Okay, and now lastly, we specify we separate the two mechanisms. That is, we introduce another concept with competition, right? Because proprietary cost argument is based on the competition. Because say if you don't have any competitor, then there's no proprietary cost at all. But if you have a high competitive pressure, then that's why proprietary cost will kick in. And so we introduce this variable as a high fluidity indicator, which is a dummy which shows that the industry is of a high fluidity, the firm is of high fluidity, i.e. it's under more competition pressure by how fast a firm's competitor move toward this first product space. Okay, it's constructed by Hopper Phillips. And Patrick? Yeah.
This is just a comment from Sikwe Fan, who mentions maybe you can think about adding tests related to the chief marketing officer characteristics in addition to the CEO tenure.
Okay, chief marketing officer characteristics. Yeah, we do know there's a management science paper about that in the marketing department by marketing scholars. They have done a paper like that. We can think how to do that. Yeah, that's something interesting. Yeah, we'll keep it in mind. I put it down already. Okay, and so this will show industry competition, and we see a very interesting splitting. That is, in industry with low turnover, i.e. low job risk, actually then the industry competition will load in explaining firms' hiding of advertising information. So what it suggests that competition actually matters. So proprietary cost argument is valid when the industry is safe for CEOs. So then their disclosure choice is really determined by really proprietary cost, competition pressure. But guess what? But for high CEO turnover industry, then this competition doesn't load. Only new CEO load suggests that then for this scenario, then the managerial self-interest matters more than industry competition pressure. Okay, so we think we nicely split out these two arguments and show different scenarios. One is dominating the other. Okay, I think I still have time. So we also do DID to strengthen a causal interpretation. That is, we split firms by using the financial reporting release of 44, FRR 44, which was enacted in 1994 end. Now, before FRR 44, firms will have to report any expenses that's exceeding 1% of sales, especially advertising, not expense, advertising and R&D. But guess what? Unfortunately, after 1944, Patrick's related to our earlier chatting, right? Then the firms have more flexibility. Then they can choose not to disclose advertising as long as they think it's not material, as long as they think and the auditor agree, and also R&D. So for me, because I'm doing R&D a pattern, right? For me, then some firms indeed start reporting R&D as well. It's a huge, it's a huge drawback. Anyway, so we design a DID based on this event, right? Like a post and a pre-period, and then we have some switcher and non-switcher. And what we find is that 20% of sample firms actually they switch to not specifying advertising. And indeed, for these firms, actually, their energy focus dispersed significant increases after the event. and their outlooks also become more pessimistic for firms. And the new CEOs are also more likely to switch to new disclosure. Yeah, so I think that gives us more like more confidence about making a causal claim about our findings. Yeah. But of course, there's no perfect identification test or whatsoever. So we have to use our caution. Yeah. Yeah, Petrus?
Brett, this is a question that it's something related to what Brett mentioned earlier, and this is the grouping of the specific disclosures versus non-disclosures. I do understand that he used the 5% of pre-tax net income, but given how many firms are loss firms, why did you not consider using 1% of sales, as there would be good justification for it based on this FR 44 as your dummy variable?
Yeah, good point. In fact, in our previous version, we used 1% sales in our previous version. And I believe there's a reason, or maybe because the jar paper argued that the materiality is better defined using 5% of pre-tax income than 1% sales. I think that's a reason why we switched to 5% pre-tax income. Yeah. But we got reasonably robust result if we move back to 1% sales. Yeah. Yeah, Brett?
I was just going to add, because these materiality judgments are quite subjective, even though they might just be above the 5% level pre-tax income or do as a percentage of sales. I wonder if you looked at those that are clearly far above those materiality thresholds versus those that are very close. Did some cross-sectional analysis, just to bring in this idea of judgment, discretion.
Okay, close to 1% or way above.
Yeah, it might even just be a cross-sectional. Those that are far away from the materiality threshold, those that are very close, something like that.
Yeah, certainly we can do some robustness by dropping those close to 1%, because then that's really up to discretion. We can just focus on those way above.
Or if you expect to find a greater effect for those that are clearly material, it seems like it'd be hard to justify with qualitative factors if the quantitative factor is so
we
large.
did a test. We split industry by their advertising intensity, and indeed we find stronger result in firms in industry with a high advertising intensity, which I think is something related to what you suggest. Yeah.
This is just a question from Lumita. She asks, have you considered disaggregating the expenditures into traditional versus digital ones, for example, online and paid search?
Yeah, we do have the data, because Kantar actually has online. They have a new sector online advertising. We can do that. Yeah, if we can do that, but yeah, but we need to think why we want to do that. Yeah, we can certainly do that just in case. Yeah. Okay, and this is the last piece that I will conclude. And related to Professor Peiman's earlier question, that is, what if they don't report the value, but they report marketing? Yeah, indeed. We actually manually collect. We hire manually and collect. As long as their expenses are about, if they don't report the value, but sometimes they package it as marketing, promotion, selling, or customer acquisition. Okay, there's a term, customer acquisition. But anyway, we count them all in. So we manually collect them, and we can construct a new variable, which is called unspecified marketing. That is, for firms, they have high Kantar observed, but they don't specify anything. Now, marketing, not advertising, actually, this ratio dropped to 4% in compared with 6% for unspecified advertising. And our main results still remain there. So I guess all we try to say is, yes, it's not because firms switching their advertising cost to marketing cost. It's really like they disclose anything or nothing, which makes our result. So so all we try to say is that we show our sincere effort in collecting marketing related expenses, but these patterns still remain there. So it's something which, for example, American Express, right? It's missing in advertising. But guess what? If you look at financial statement, they call it marketing, promotion, rewards, and the cardholder services. And the amount is what? Only 5 million? No way. It must be 5 billion. Okay, I see. Yeah. Anyway, just show you an example. Okay, so I know this crowd would like to know more about policy implications because this is for the accounting design. So these are some of our reflection on it. That is, we show that analyst effort do not fully compensate for lack of transparency, even though they ask questions. And so we suggest that disaggregation of accounting costs will enhance the credibility of accounting information. So in fact, the newly coming FASB, which will be effective at the end of next year, requiring firms to report selling expenses, but also maybe other expenses as well. I think it's a good start. It's a good recovery, I would say. Yeah, and because we provide concrete empirical evidence for that disaggregating selling advertising related expenses benefit investors. And the second policy implication we want to highlight is intangible investment in assets. Because nowadays, you look at top 10 firms, right, in market cap, I guess most of them their value come from intellectual property rather than physical assets, right? But such investment and assets are hard to quantify in financial statements. Well, should we allow more managerial or editor's discretion in valuation of such assets, or should we even allow firms to capitalize instead of expense intangible asset? I know this question has been accounted since the 80s. I read Professor Baruch Lab's paper, right? Since the 80s, since the 90s, it has been like this. But unfortunately, after 40 years, 4 decades, we still know very little about how to quantify this kind of intangible asset. And the last policy implication we want to suggest managerial interest actually may bias, may influence disclosure practices. How do we mitigate such an influence? Would be something worth consideration. Okay, I think I finished right on time, and I would like to bring you to the next virtual event. It's by Professor Joshua Livnet. I think I will let Ayong to introduce it. And so that will be my talk. I thank everyone for all your wonderful questions and your great input. Yeah.
Thank you, everybody. So in 2 weeks, Joshua Livnet is going to present analysts' strong views and market reactions, and you are welcome to register for the event on our website. Okay, so I'm going to thank you, Paul and Petrus. I'm going to stop recording, and if you have some offline questions, Paul has a few minutes.